Hello, fellow risk takers, and welcome to my worst investment ever. Stories of loss to keep you winning. In our community, we know that to win in investing, you must take risk, but to win big, you've got to reduce it. Ladies and gentlemen, I'm on a mission to help 1 million people reduce risk in their lives. To join me, go to myworstinvestmentever.com and sign up for our free weekly Become a Better Investor newsletter, where I share how to reduce risk and create, grow, and protect our wealth. Fellow risk takers, this is your worst podcast host, Andrew Stotz from A Stotz Academy, and I'm here with featured guest Jack Farley. Jack, are you ready to join the mission?
I am so ready. How could I not be after that fantastic intro?
We are going to help 1 million people. Now, let's get you and how you're helping people out to the world here. So let me just introduce you to the audience. Jack is the host of Forward Guidance Podcasts, a podcast I listen to regularly. He's interested in all things liquidity, macro, and central banking. Jack graduated from Brown University with a degree in economics and has done nearly 500 long-form interviews on investing and macroeconomics. You can find him on Twitter at JackFarley96, which I'll have a link to that and all other items in the show notes. Jack, take a minute and tell us about the unique value that you are bringing to this wonderful world.
Well, thank you, Andrew, for that very kind introduction. So the term unique, I just start by saying that what you and I do is very rare. There aren't a lot of people doing it. Yes, everyone knows that the podcasting world is, there's saturation. Everyone wants to have a comedy podcast where it's just a couple of friends talking about sports, but like actually doing interviews about finance, yes, there are a lot, but there aren't as many people who do it as prolifically and as a full-time gig. So I sort of view it as just go where there's no competition. Like if I wanted to be a shortstop for the New York Yankees, if I wanted to be in the top 100, you're competing against so many people. But if you're want to excel in a field where it's very niche and you're not competing against that many people, your odds of success are a lot higher. I'd say in terms of what I tried to bring to the podcast that's unique is I'm not an expert. I haven't worked in the financial markets for real as a trader, but I'm attempting to understand it on a level that I think is typically like a little more than what you'd see on the newscasting. And I think that what's great about podcasting is that it allows you to go in depth. And I do a lot of episodes like you.
It's kind of interesting for the listeners out there. Maybe we talk behind the scenes a little bit, because I do my podcast as a very small part of my week. I batch all my interviews in a short period of time. I'm boom, 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 and then it's done. And my type of interviews are not the type where I have to do a huge amount of prep, get myself ready, and then they're not long form. I mean, sometimes we can go on for long, but generally I've kind of designed it that way because I've got a lot of other things that I'm doing in my life. But I feel like what you're doing is a lot more dedicated, and it'd just be interesting. So the audience kind of heard how I do it there, and I'm just curious if you could explain, like, what's the background of where does this podcast, Forward Guidance, fit into your life, and how do you do it?
It's a full-time job, and I'm thinking about it very frequently. I'd say I just do the same thing that you do, but you have this whole other life, and I don't know how you do it. I mean, I could do 3 interviews in a day, 4 interviews in a day, but it really takes it out of me. And I feel like a 20-minute interview is very tough if it's going well. I don't know. I'm sure you've done all these fantastic interviews that are 20 minutes. I don't know how you press stop, it's tough. And, some podcasters do 3, 4, 5 hours. I mean, I've seen interviews about, Bitcoin, and like crypto is enormously complicated, but Bitcoin itself, the technology, very complicated. But the idea of Bitcoin as money, it's a 5-minute conversation. It's like there are 21 million of them, but that's the end of the conversation. But I've seen people do like 5-hour interviews about Bitcoin as money. And it's like, there's an audience for that. And, there's an audience for a 90-minute interview about the plumbing of the Federal Reserve System and the financial system. So, yeah.
And if somebody's listening and they think, I want to do what you're doing, what would be your advice, kind of, when you go back to the beginning, the mistakes you made, the different things that, that worked, that didn't work? I'm just curious, just because, I'm listening to your podcast over here in beautiful Bangkok, Thailand. And, it's, and then I'm talking to you and I'm hearing all the commitment that you've got to that. But I'm just curious, like, what advice would you give someone who's, serious about doing it?
Well, see, I don't want to give like too good advice and then I create a monster who just,
No.
competes with me. But let's see. I'd say you have to start somewhere where you get a little bit of buzz, a little bit of people glomming on. Like, you don't want to start with an audience of one, because then if you double your viewership, you will have 2 viewers, and then if you double it again, you have 4 viewers. So so you want to start with a pretty big bang. I think if you're someone who worked in media before and you have a little bit of following, that can be great. The previous company that I worked at, gave me a lot of opportunities to do on-camera interviews, and I'm using those skills in the show today. My podcast for guidance is video as well as audio, and yeah, I think it can really help to start from having done a lot of them before. I'd say it can be really tough for someone to sort of have a full-time job and then launch this on the side. I mean, you've done that, but you're in the financial world, so that was your way to get into it. And I lastly say, like, don't do it unless you love it, because it's going to become the work that you're going to have to do is going to become real work, as in unpleasant work, very soon if you don't love it.
And one other question is, how should someone think about monetizing? I look at myself, and because it was kind of a sideline thing, and actually I started it, at a time where I felt like I really need to reach out more. I'm kind of stuck in my office. I'm an analyst. I just dig down deep and I do my work. And I saw it as a way of kind of forcing myself to get out and talk. I know I have the skills there, but if I don't force myself and have some kind of structured way of doing it. And so I saw it like that, and I saw the value of building my relationships, and I didn't have a clear monetization path. And sometimes I regret that, because I think that my podcast isn't aligned with any particular product. Like, I look at Amy Porterfield, she has online courses, she has a podcast. I like what she does. I've attended her courses, and it's like perfect alignment. She does an episode. It's exactly about what you want to know if you're going to do an online course. And then you go to her website, you get the materials that she provides related to that episode. And then she says, okay, why not take the online course? So there's like this perfect alignment that I never got. And now I see the pros and cons in it, but I'm curious, like, how should a beginner think about monetization or that type of thing?
So the first thing I say is, if you're truly a beginner, don't think about monetization, because you're not going to make any money, because if you're a beginner, you don't have that many viewers, and it's not going to be worth that much anything. I don't think I'm at the point really where monetization should be what I'm thinking about the most, because I feel like if I focus a lot on content now, I can grow it so much more. And then in the future, so you're finding this guy, like the future value will be worth. I am thinking about it a lot, and I guess you want to have sponsors who are aligned with your product, where your audience is interested in their product, and also that they recognize the value of the podcast. I mean, you know this, that it can be sometimes difficult for people to track how times people, like, so if let's say I have a TV show, and Swiffer, the mop, runs an ad, and it can say, oh, 40,000 people watched this. For some time, like, the people who are paying all this money for the TV ad, they just accept that. Whereas if they sponsor on your show and 100,000 people listen to it, for some reason they specifically were like, well, how do we know how many people bought it? Like, can we do a code? So they want attribution, which can be very difficult. But end of the story, podcasting is the future. I'm super bullish on podcasting, and I'm pretty bearish on TV and legacy media. I think excellent work is being done there, but it's just like, where's the growth? And you got to go. That's one thing I say, is go where the growth is. Like, if you go to, if you're going to work at an industry that is like slowly dying and decaying, like expect that, know that that's the industry that you'll be going into. Don't expect like, oh my God, how come like they're not paying for my dinner? It's like, because the industry itself is dying, you know?
Yeah, it's a good
What was your
lesson.
original, what was about sponsorship and monetization? Yeah, I feel like that's one model of the course model where,
Mhm.
okay, I'm Jack Farley and people listen to my show and the sponsor is me because I have all these courses. That's good. But I feel like it's a recipe for a good podcast, but not a great podcast. I feel like because you're not, the goal is to just make as much money as possible for you. You're like, you're not pursuing absolute truth. I actually
Right.
feel like pretty well about it. Like, I feel like you should be making the best content possible, and then sponsorship monetization should be second, and like people will pay you even more because you'll get even more views because the content is so good. You know,
Yep.
if people can tell the difference between, oh, this is actually okay, oh, this is good content, and I like this. I'm learning. It's hitting all the buttons, the emotional buttons about the Fed's balance sheet, blah blah blah.
Right.
People can tell between something that's just hitting the buttons and something that's really good. And they're long term, the stuff that's really good is going to grow the best.
Yeah, I mean, when I listen to your podcast, I get the feeling like you've got a list of questions you want to learn, you want to get information from this person and try to, understand it, which brings me, before we get into the big question of my podcast, I'd like to just, you've done so many different interviews on banking system and particularly, US banks and what's going on there. I have a portfolio allocations I do for clients here, and we made a small allocation to banks, a global bank ETF, because some signals were turning a little bit positive. And then a week later, Silicon Valley Bank goes boom, and it went down. That portfolio, the ETF went down a bit right from the beginning. It bounced back a bit, and then it started to go down. And it's concentrated in large banks, so they're actually gaining probably from it. But having been a bank analyst and knowing from my own perspective that I don't want to be in something that's a small part of the portfolio that I got to sit there and defend for the next, 6 months. And so I decided to exit that position and just watch it unfold. But I'm just curious, from all the different interviews that you've done, what is your perspective on kind of where we're at with this banking situation in the US? Is it a crisis that's going to unfold and explode, or is it a small impact that's been dealt with and we'll move on from that?
It's funny. Everyone who's at a different part with different interests uses a different word to describe it. So if you're in the media and you want to generate buzz and clicks, you say it's a crisis. And I'm in the media, so I call it a crisis. And I think to some degree it is a crisis. But if you're in the bank industry, you say, oh, it's just a little bit of stress.
Everybody calm down here.
Tremor. Yeah, so like if someone's interviewing the Bank of America, they're like, it's a tremor. It's not even it's a little bit of stress. So before I answer your question, and I want to say that I think the guru business model is like steroids in that short term, you can have a lot of success, but long term, you're doomed to have some consequences. So yeah, I'm not a guru. I don't make predictions. I have views about individual stocks, the stock market, banks, bonds, and you'll rarely hear me say that on the show, just because it's not even for a noble reason. It's just there's no benefit to me making a prediction, because if in terms of like what I gain, if I'm right, people recognize it as like +1, but if I'm wrong, it's -50 for my prediction.
Yeah, exactly.
So there's just nothing. There's it's just a total asymmetric payoff.
So
and
we're
like,
just tapping into your learning. We're not tapping into your predictions, but that makes sense. I understand that.
Yeah. And you get that. Like, I can tell you're a really humble guy, despite all the experience that you have. Let's see. I don't know. I mean, it's just been a really interesting time. I feel like I've learned so much more about the banking sector during this episode. And there's no way I would have been, kicking the tires on these banks and learning about like, economic value of equity, unless there was a crisis, you know what I mean?
Right.
So everyone learns stuff during a crisis. Let's see, I mean, can you
well, that's, I think one of the things that I think we're all kind of wondering is like, we're seeing the commercial real estate industry kind of getting clobbered. Already we saw with the pandemic, or with the pandemic response, that buildings were hollowed out. People aren't necessarily coming back to those buildings. Those community banks have exposure to a lot of real estate. That's really on the ground work that they do. And if I look at the balance sheet of the banks, particularly, let's say, regional banks, they have cash on their balance sheet and they have government bonds. They can now get those government bonds over to the Fed and get a little more cash. But still, they have a large amount, and they have some mortgage loans, but they can pass those mortgage loans on to Fannie Mae and Freddie Mac and get those off their balance sheet, and they got cash. So really what they're left with is this commercial real estate and business loans and consumer loans. And I guess the question is, like, is this, the Fed can't buy commercial real estate right now from the banks. But one of the questions I have in my mind is, are they going to come up with a vehicle where these guys are going to be in such a trouble that, there's 100,000 buildings in America that are never going to have the occupancy that they had in the past. And therefore the economic value of those buildings is going to go down. Is that really a crisis? Is that really a problem? And I haven't been in the US in 7 years, so I haven't even really seen, what's going on, but maybe just your feel from what you've heard from people, and what you're thinking about that as far as those regional banks.
Right. So a lot of great questions in there. I think that when it comes to commercial real estate, I think a lot of the fundamentals weakness is in offices, because I'm in an office right now, but the fact is that a lot of companies, including blue chip corporations, are still allowing people to work from home or do part-time work 2 days a week, 3 days a week. So just the marginal bid for office real estate and that square footage is just not as strong as it used to be. And I think you can see that in the real estate investment trust stocks like SLG or VNO. So I feel like you're having price discovery in the public markets where, you're getting a quote on these things every second, but in the private real estate market, you're not. And on the bank balance sheets where they've lent against this, so they have, real estate debt, you're not, it's still being quoted at par. I think it's fair to say almost all of the stresses in the banking sector that we've seen in the past, we're recording this on, I think, May 10th, has nothing to do with that. I think that's all to come in the future, and the shoe will drop. How heavy of a blow it will be, we'll see. But I'm pretty confident that everything that we've seen, most of what we've seen, has been interest rate risk related, not credit rate risk, not fundamentals of the loans on the asset side and the liability side. And as a former bank guy, you know a lot more about this than I do, right?
Yeah, it's interesting. It's like the Fed dropped a bomb in the middle of the ocean, and there's this massive wave that just goes whoosh, and there's just one. And if you can survive that one, okay, now you recover, and okay, now we go back to kind of normal. And what are the issues that these banks are facing? So yeah, I would say that's one angle to it, is that it's just kind of a one-off. I mean, I was always kind of surprised that the Fed raised rates so aggressively. I just thought that that's such a dangerous thing, but what do I know? But
yeah, go ahead.
Most important question of this whole interview is the one that I'm going to ask you right now. And that is, now it's time to share your worst investment ever. And since no one goes into their worst investment thinking it will be, tell us a bit about the circumstances leading up to it, and then tell us your story.
Well, Andrew, from the name of the show, I knew this question was coming. And I have to say, it's not even close. Because unless things go disastrously wrong, the most you can lose is everything. So the least you'll be left with is zero, unless you use margin, which we don't recommend, obviously. But yeah, this is an investment that purely went to zero. And so the circumstances that went into it actually started very fortuitously. I had gotten quite bearish on the market in January or February of 2020. And just another thing I want to say is, a really important skill is to know when you were right because you were smart and made a decision versus when you were lucky. This is purely on the latter thing. I realize now it's just because I was consuming a lot of macro content that was quite bearish, which is not good track record for long-term track record success. Is just like do what the people in the podcast are saying. Like, but I got quite bearish on the market, so I bought a lot of long-term, a lot of put options on the markets and individual stocks, but in particular Tesla. So I bought a lot of probably 30-day, 60-day, 90-day options on Tesla in January, really honestly in February. So I actually timed it perfectly. So, and these stocks, as you know, all individual stocks crashed, throughout early March, and the volatility on them also crashed. So I made so much more money than I even thought was possible, because it's like I on the realized thing, I probably made like, it was a 4-bagger, 5-bagger. But then because the implied volatility was so much more expensive and I was long volatility, it was like a 20-bagger. So I literally, and at the time, I was young to the investment world. My first investment actually was in a pharmaceutical company in 2014 that actually, like, weeks after I bought it, got cut in half. So which I actually think is a good thing. It's much better to have bad luck in the beginning, because you start to think about it. But that's probably my second worst investment. But my worst investment. So I went to the time when people who had bought bonds that were up 5% when the market had crashed 30%, they were feeling smart and good, and they were going around talking about how much money they had made. So I had just this huge asymmetric explosion of profitability at the time when the global world had a giant financial meltdown, and everyone was losing all this money in the market. So
but by the way, this is like a dream, right? That and for the listeners that don't understand options, basically what you're talking about is that you made a bet that particular market or particular stocks were going to go down, and you would profit if they went down, and they went down.
Yes. And then the odds that the market was assigning to that it would continue to go down and be volatile was very high. So just the particular flavor of security that I was long was like suddenly became the hottest thing, because implied volatility went from like 60 to 200. I think how this story ends.
Yes, I'm anticipating it, but it's interesting.
Yeah. So those are the circumstances that led to that environment. So it was very favorable to start off with.
So you're sitting on massive unrealized gains.
Correct.
Continue.
And I continued to consume this bearish macro content that, by the way, was not just coming from individual alternative sources, but CNBC, Bloomberg, the Wall Street Journal, and how I can talk into the media later of it's extremely backward looking. So the media was probably the most bearish on March 23rd, which was the absolute bottom in the stock market. And I continued to listen to it. And when the stock market, rallied from March 23rd to April 1st, I was told it was just a bear market rally, and I believed it. So my 20-bagger became a 13-bagger, and then the 13-bagger became a 8-bagger, and the market continues to grind higher. The bear market rally is coming, and I did not realize a gain at all. In fact, I realized a loss because that position went to zero. So, $1 to $20 to zero. And looking back, I knew when that happened that was really dumb, and I was, embarrassed about it. But looking back, I just realized just how huge of a mistake it was, because even if it went from 20 to 13, you still should monetize. Even if it went from 20 to $1.20, you still should monetize it. That's not the market doesn't know your position, your P&L, profit loss does not know that it was a 20-bagger. It's still the fact that you were up 20% on that. And it was horrible. Yeah.
Yeah. One of my guests recently said one of the things that I loved, and I just never forget it. He says, the market is a predator. Coming after your money. And
I think it is in a way, because the investors are predators and they're going after the market, but the market, so everyone's just going after each other, trying to beat the market. And alpha can only be gotten if someone else loses. And I really do think that's to be true for trading. The market itself is not zero sum, but stocks are, and trading is. So yeah, it's really tough to beat the market. And, I made a tweet maybe about a year ago when I was having some favorable results as well, when I, on a certain thing that the certain time horizon that my brokerage tracked, I had beaten the market. And I said, like, the ultimate hack is just to beat the stock market. And then as soon as you do, just invest in the S&P 500 for the rest of your life. And then you'll always have done it. Of course, I did not listen to my advice. Yeah.
Yeah, well, the thing that I try to teach, particularly, I wrote a book called How to Start Building Your Wealth Investing in the Stock Market, which I wrote for women. In fact, I wrote for 5 women, which are my 5 nieces. And when they graduated from high school, I gave them each $3,000, which was the minimum to set up a Vanguard account. And then I got them started in investing. And I basically just told them, just buy the Vanguard VT fund. It owns 9,000 stocks, and just, contribute to that. But what I tried to help them understand is you got to separate. You hear in the podcast, I say, create, grow, and protect your wealth. What I didn't realize when I was young, and I mean, I still did pretty well, but that the first thing you need to do is set up your wealth creation engine. And that is either a business that you own, or it could be your salary. If you're making $10,000 a month and you're spending 9,900, well, you're not generating much savings. But if you can say earn 10,000 and spend 6,000, you've generated 4,000 in savings. You've created wealth of 4,000. Now the question is, how do you then view that creation of wealth and shift it into the growing? And that's where I look at the stock market. So that's why I say create, grow, and then protect after all the work I've done on the podcast. But let me ask you, how would you summarize the lessons that you learned?
That's a great question. Number one, don't be cocky. When a windfall is bequeathed to you, to the market, and fortune has assigned you, lucky enough to be the one who wins the day, don't assume that it's because you're so smart, because most likely it's not. And in my case, it definitely was not. And realize those gains, and at the very least, trim the position down. And honestly, it was only one put option. It went up. It was only one contract. It went up by so much that it actually became like what I considered a large amount of money. But it was only one contract. So I was like, oh well, if I had 5 contracts, I would sell 2, but I can't because it's just one. Now I view, like, just, I realize that that's so dumb. I should have either just sold the contract, or entered into rolled it down to a lower strike, bought some of the underlying stock to hedge the delta. Like, I didn't know any of that at all. So that's another thing, is don't play in markets where you don't know what you're doing, unless you view it as the education cost, the tuition for learning in the market, which it kind of was for me. But I didn't realize that at the time. And yeah, like, if you're a doctor and you're being a doctor 70 hours a week, that's your profession, like, why would you ever think that you would make money trading VIX futures against someone who does that for their living? That's their doctor, that's their surgery. They're going to crush you, like, 100% of the time, not 99% of the time, 100% of the time. You choosing Microsoft over Apple against a portfolio manager, you have a better chance there. But yeah, the more complex the markets, the less you know about them, and the more sophisticated the institutional investors are, the more chance you will be crushed over time. Don't I forgot what I was going to say.
But let's go back to that doctor thing, because that's a great example of create, grow, protect wealth. The objective of a doctor, that they're generating really great wealth they're creating wealth through their work. And if they can shift their mindset to see the market as a place to grow their wealth, not to create wealth, then that can help them to set up a different strategy when they go into that market, versus, I'm going to nail this and I'm going to, I've got the great strategy and I've read all this stuff. No, don't view the market as a place you're going to create your wealth. View it as a place you're going to grow your wealth.
Yeah, I think that's phenomenally true. And yeah, I'd also say, don't take your profits.
Yeah. Yeah. And I'd say in my what I would say about this is that having a way of understanding when your portfolio moves in an extreme way, up or down. Be prepared ahead of time for what you're going to do. So for instance, in stock portfolios, I have stop losses. I mean, I'm a fundamental analyst and I love the idea of, no, it's getting cheaper, I'm going to buy more. But hey, come on, I cannot survive, and my clients cannot survive that down cycle going all the way down, 50, 60% or whatever. And also I know that, when something's going up a lot, take some of that and put it into other parts of the portfolio. So I think that's really as soon as you've made a major gain, and one of the easiest ways to do this, take half of the position off. Yep. Don't take the whole thing. Just take half. And if that's a stock that's crashing, take half that position off. And then you can say, okay, fine. For the other half, I'll let it go down and I'll try to buy more. And for something that's going up a huge amount, take half the position. It's one of the tricks that we can play, for our minds to help us feel more comfortable to do that. But let me ask you, based on what you've learned from this experience and what you've continued to learn, like what would be one action that you'd recommend for our listeners to help them avoid suffering the same fate? They're in the same situation. It's a huge gain going on. What do they do?
I would say, don't play in markets where you don't know what you're doing. Like at the time I would have said, oh, I can't cut my position in half because I only have one contract. Whereas now I said, you could roll down the strike, you can buy the underlying, you can sell the contract, sell the underlying. And if you do want to have the tuition be your cost, do it on a stock that costs $5, where, the option is 5 cents. So your $5 can turn into $50 and then $0, which feels a lot nicer.
Keep it simple. All right. Let me ask you, what's a resource that you'd recommend for our listeners? Obviously there's your podcast. Are there any others, or tell us about also, what should a listener expect if they go to listen to your podcast?
They should expect a deep dive conversation on finance that is typically associated with what's going on now. So I've been doing a lot of bank episodes, but I also like to incorporate longer term themes. Like I just did a history, interview about the Federal Reserve's, not just its founding in 1913, but changes that were made to it in 1917 that actually enabled it to sort of print a lot more money because of, various things. So yeah, I'd say a deep dive, long form, intellectual honesty, balls and strikes. I try and break things down for the audience because a lot of things are complex, and like I'm learning in real time too, along with the audience. But yeah, like a lot, it's like going to be, if you watch one of the TV networks here, this is real salesy, sounds like a little cocky, but if you watch one of the TV like finance networks, that's going to be like drinking a beer, and like listening to my show, Forward Guidance, is going to be like doing, psychedelic or something like
that. With a glass of wine.
Yeah.
This is not crack.
Yes.
All right. So last question. What's your number one goal for the next 12 months?
Grow the show a lot and produce kick-ass content.
And just give us an idea, like how many episodes you feel like it makes sense in the next 12 months for you? Like, what does it mean by grow the show?
Just the amount of listeners on YouTube as well as audio only. So the show as a podcast we heard on Apple Podcasts, Spotify, all the other podcast apps, and then on YouTube as well, under the channel called Blockworks Macro, which is sort of the parent company. Yep. And Forward Guidance is the name of the show. So yeah, just that total number just should go up. Like a moving average of that should go up. And if it does move up by a lot, I'll be happy. And if it doesn't move up, I'll be, not happy and motivated to do it again. In terms of, so to be clear for the audience, it's an interview program like yourself. So it's never just me. It's me and someone else, sometimes me and 2 other people. Like I've done a lot of interviews with Joseph Wang, he's the Fed guy who has blown up over the past year, and we sometimes have another guest on, but it's not just me. So like it's a lot better than just me. Like I fundamentally don't view myself as someone who like has a lot to say about markets. Like, and if I do, it's because I've heard it from a guest, you know what I mean? So it's always like the guests are really what drive it. So it's all about having the best guests. And yeah, I'm really excited about some of the guests who are coming up on Forward Guidance. Like over the next month, 2 months, I'm having on Sheila Bair, who used to run the Federal Deposit Insurance Corporation, who shut down the largest bank in American history. Like for record, First Republic was the second largest bank.
Right.
Silicon Valley Bank was the third largest bank. Like she shut down the largest bank in 2009. I'm having someone on who used to be on the Federal Open Market Committee at the Federal Reserve, having him on like in a month or two. And yeah, I'm targeting a lot of big names. So
Yeah, that's
check it out.
exciting.
More guidance, Blockworks Macro.
Yep. And I'll have links to that in the show notes, and you can just type it into the podcast app that you listen to, Forward Guidance, and you'll enjoy it, I'm sure, as much as I do. All right, listeners, there you have it. Another story of loss to keep you winning. Remember, I'm on a mission to help 1 million people reduce risk in their lives. If you've not yet joined that mission, just go to myworstinvestmentever.com and join my free weekly Become a Better Investor newsletter to reduce risk in your life. As we conclude, Jack, I want to thank you again for joining our mission. And on behalf of A Stotz Academy, I hereby award you alumni status for turning your worst investment ever into your best teaching moment. Do you have any parting words for the audience?
Thank you it's an honor to be alumni. I feel like a winner for having been on this show. And I can't believe that I haven't heard of this before you emailed me, and I'm really glad you did, because you've done a phenomenal job. And yeah, I'm just really glad I'm really glad of this conversation.
Well, we're glad to meet you and learn from you. And that's a wrap on another great story to help us create, grow, and protect our wealth. Fellow risk takers, let's celebrate that today we added one more person to our mission to help 1 million people reduce risk in their lives. This is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.